imagine a company that's just, bleeding nearly $50 million a year in operational cash, and it's suffering this brutal 30% stock crash over the last 12 months.
Yeah, it's a rough picture.
Right. But then somehow they're sitting on nearly $500 million in cash while day traders are just violently fighting over its shares. I mean, you look at a stock like that, which suddenly spikes, I think it was 15% in 5 days, and you really have to ask yourself a question.
Is it a screaming buy or?
Exactly. Is this a misunderstood, undervalued gem, or is it just a classic trap waiting to catch retail traders? So today, we are diving into a literal financial paradox. We're pulling out the microscope to analyze BigBear.ai Holdings, Inc. That's trading under the ticker BBAI.
And honestly, it is a fascinating, almost contradictory setup. I mean, the data we have paints two completely different realities. It really depends on whether you're looking at their past operational performance or, their current war chest.
Yeah, it's wild, and our mission for this deep dive is to basically peel back the layers on that recent, frankly, insane price action. We're going to decode these incredibly conflicting signals flashing across the technical dashboards and try to make sense of the deeply polarized market sentiment surrounding it.
It's definitely polarized, that's for sure.
Oh, absolutely. Now, real quick, before we tear into the balance sheet, just a bit of housekeeping. Whether you're listening to the audio or watching us right now, hit that like button, subscribe to our YouTube channel, and look, it is compulsory that you leave us a comment with your feedback on this stock. We want to know exactly where you stand.
We definitely read all of them.
We do. Also, we had to make this crystal clear right up front. This deep dive is a natural human debate and an educational analysis of the source materials. This is strictly not financial advice. I mean, we are here to help you understand the mechanics, not tell you what to do with your own portfolio.
Right, you've got to make your own calls. And to set the scene for you, let's look at the snapshot as of today, April 16th, 2026. So BBAI closed at $3.75.
Okay, so a little bit of a dip.
Yeah, it's a minor 1.06% decline for the daily session, but it is riding the sudden 15.2% short-term wave. However, if you zoom out a bit, you're looking at a long-term 30.6% drop over the past year.
Ouch.
Yeah, and the 52-week range is incredibly wide, going from a low of $2.36 all the way up to a high of $9.39.
Wow, okay. That is a massive 75% peak to trough spread. I mean, when a stock falls that far, it usually means the underlying business is, well, broken. And I think that brings us to our first major mystery here. How can a company's balance sheet look so entirely disconnected from its income statement?
This is the big question.
Right, so let's look under the hood, starting with the fiscal year 2025 results. What are we seeing?
Well, honestly, the 2025 income statement is just a tough read. The top line contracted significantly. Annual revenue came in at $127.7 million. That's a 19.3% drop from the $158.2 million they had in 2024. But what is really alarming, like red flag alarming, is that the bleeding actually accelerated at the end of the year.
Oh, really?
Yeah. Q4 revenue specifically took a massive 38% hit year over year.
Wait, 38% in a single quarter?
Yep.
I mean, that's not a rounding error. That's not a seasonal dip. That is a structural cratering.
Yeah.
Why did the volume suddenly just drop off a cliff like that?
So the primary driver was lower volume on U.S. Army programs. And, when you're dealing with government defense contracting, those programs are supposed to be your reliable, recurring anchor.
Right, because the government's supposed to be the ultimate safe client. I mean, they always pay their bills.
They do, absolutely. But defense contracts, they operate in these cycles. You have legacy systems phasing out and next-generation systems ramping up. Oh. So if you're tied to a program that sees a volume reduction, and this happens a lot, if there's a gap between old contracts expiring and new ones actually starting, it just rips right through your income statement. And that top line drop, it flowed straight to the bottom line. They reported a staggering $293.9 million net loss for 2025.
Okay, let's unpack this. Nearly $300 million in losses on only $127 million in revenue. That means an earnings per share of what, negative 82 cents?
Exactly, negative 82 cents.
Plus, they reported negative free cash flow of negative $47.2 million. So they're burning cash just to keep the lights on at this point.
Yeah, the operational cash burn is a really severe headwind for them right now.
But hold on, here's where the math totally stops making sense to me. We're looking at a company bleeding nearly $50 million a year in operations. Yet, if we look at their balance sheet at the end of 2025, they're somehow sitting on a massive cash and investment pile of $462 million.
It sounds impossible, right?
It feels like a sports team that lost every single game this season, but somehow just bought $1 billion stadium. Where did $500 million come from if the business is losing every game it plays?
Well, that's the paradox. Because that massive net loss of almost 300 million, it isn't all cash just flying out the door.
Mhm.
A huge portion of that was impacted by non-cash impairments and debt settlement costs.
Oh, okay.
The real structural shift actually happened more recently in January 2026. That's when they successfully reduced their debt by settling $125 million in convertible notes.
Wait, they didn't magically find the cash to pay off that debt, did they?
No, not
It's like realizing you can't pay your massive credit card bill, so instead of handing over cash, you give the bank a 10% ownership stake in your future paychecks.
Yeah.
Like you keep your cash today, but your future is totally diluted. They get a debt-to-equity conversion.
That is a highly accurate way to frame it, yeah. They didn't hand over $125 million in cash to the note holders. They gave those debt holders equity, literally newly printed shares in the company.
Right.
So the cash pile remains robust at $462 million, and the debt burden is lifted, which, is great for survival, but the existing shareholders absorb the dilution.
Their slice of the pie just got way smaller.
Much smaller, and that heavily contributed to that painful net loss figure on paper.
Wow. So they sacrificed the shareholders to fortify the balance sheet. Man, so if the fundamentals are this messy, and existing investors just took a massive dilution hit, that has to be spilling over into the price action. I mean, are we seeing that blood on the charts? How are the algorithms and the day traders actually processing this?
The technical picture reflects exactly that trauma. I mean, the overarching trend channel is unequivocally falling. Investors have just been accepting lower and lower prices just to exit their positions and get out.
Yeah, cut their losses.
Exactly. And if you look at the 200-day simple moving average, which, averages out the closing prices over the last 200 days to give us a gauge of the medium to long-term trend, that range currently sits between $3.66 and $5.79.
And since we close at $3.75, we are pinned right at the absolute bottom edge of that moving average.
Which means the stock is trading below the heart of its historical baseline. The market is just heavy. Every single time the stock tries to rally, there is this ceiling of trapped investors who are just waiting to sell and break even. And that pushes it right back down.
That makes a lot of sense.
Mm-hmm.
So for the traders watching this deep dive, trying to actually navigate this heavy market, where are the actual battle lines drawn here? What are the critical levels of support and resistance?
So the floor, like the immediate support line, is at $2.99. If the selling pressure breaks below that, traders were going to look straight down to the historical 52-week floor,
Which is?
$2.36. That is the ultimate line in the sand right now.
And on the upside, we closed at 3.75.
Right. Immediate resistance sits right above us at $3.77.
So it is literally knocking on the door of that resistance right now. I mean, it's just 2 cents away. If it breaks through 3.77 with actual volume, what happens next?
If it pierces 3.77, the technical traders will see that as a bullish continuation signal. The next major target they'll aim for is $4.31.
Okay.
But breaking resistance requires momentum, and right now the momentum indicators are highly, highly conflicted.
Oh, they're completely contradicting each other. I mean, let's look at the RSI, the Relative Strength Index. It's sitting nicely between 46.5 and 60.3.
Right.
And since RSI is a 0 to 100 scale, measuring how fast the stock is moving, sitting right around 50 means it's dead neutral. It's like a coiled spring. It's neither overbought nor oversold, meaning it has room to run in either direction without just snapping back from pure exhaustion.
That's true. But then you look at the MCD, the moving average convergence divergence, and the story totally changes.
Yeah, it really does.
The MAN-CD looks at the relationship between two moving averages to gauge momentum shifts. And on the daily charts, the MAN-CD is actually flashing a slight buy signal at 0.0076.
Meaning the immediate day-to-day action wants to push higher.
Right. But the short-term momentum reading on that exact same indicator remains bearish at negative 0.203.
Okay, so for someone not staring at trading algorithms all day long, what does that conflict actually translate to in the real world?
It means the algorithms and the momentum traders are deeply confused. The immediate daily price action is trying to push up, testing that 3.77 resistance. But the slightly broader short-term momentum is still pulling down like gravity.
Wow.
It is a literal tug-of-war between the bulls trying to build a base and the bears aggressively selling any bounce they see.
And Wall Street hates uncertainty more than anything else. So if the charts are caught in a violent tug of war, what are the institutional analysts and the fundamental valuations signaling right now?
Well, the current consensus on the street is a hold or a moderate buy, with the average price target hovering between $5.33 and $5.50.
Which is significantly higher than the current 3.75. But it's not all sunshine. I'm looking at the recent adjustments, and on March 3, 2026, Cantor Fitzgerald actually lowered their target from $6 down to $5.
Yeah, they did.
That's a very public negative signal right before this recent 15% spike.
And that downgrade almost certainly stems from the fundamental valuation reality. This is where we really have to talk about the price to sales, or PS ratio. Currently, BBAI's PS ratio is roughly 13.5x.
Hold on. You're telling me a company with declining revenue is trading at 13.5 times its sales? That is insane.
It is incredibly steep. What's fascinating here is that a 13.5x multiple is a premium valuation usually reserved for hyper-growth tech companies.
Yeah.
Software companies that are doubling their revenue every single year trade at 13x sales. Traditional defense contractors, they usually trade at 1 or 2 times sales.
Right.
BigBear.ai is trading at 13.5x, while their revenue actually shrank by almost 20%. That mathematical reality suggests the stock might still be fundamentally overvalued unless they can miraculously accelerate growth tomorrow.
And this setup, it leads us directly into the psychology of the market, specifically the undervalued versus value trap debate.
Yeah.
Here's where it gets really interesting. You have retail traders logging into their brokerage apps. They see a stock trading at 3.75. They look at the 52-week high of 9.39, and their brain automatically says, wow, this is cheap. This is on a massive discount.
Exactly. Behavioral finance calls that cognitive bias anchoring.
Anchoring.
Right. Retail traders anchor their expectations to that 9.39 high. They assume the stock is quote-unquote supposed to be up there, and anything lower is just a bargain.
But they ignore the underlying machinery. They ignore the 47 million negative cash flow. They ignore the insane 13.5x valuation on shrinking sales, and they completely ignore the dilution that just happened.
Exactly. They buy in thinking they are catching the absolute bottom, but because the broader trend is a falling channel, the stock just keeps making lower highs and lower lows.
Yeah.
They end up trapped, basically holding the bag in a long-term downtrend, wondering why their, quote, cheap stock just keeps getting cheaper.
So to give you, the listener, a completely impartial picture, we need to stress test both sides of this argument. Let's debate the absolute extremes here. Let's start with the dark side. What is the ultimate worst-case continuation scenario?
Well, the bear case is rooted in those terrifying operational numbers we talked about. It's not just that top-line revenue shrank, it's the profitability of what actually remains. Their margins have cratered to 20.3%.
Down from what?
Down from a previous 37.4%.
Wow, that is a brutal margin compression. You are making significantly less money on the very contracts you actually managed to keep.
Yeah. When you combine collapsing margins with negative revenue growth and that sky-high relative valuation, the math becomes very, very unforgiving.
Yeah, bad.
If management cannot reverse this operational cash burn of $47 million a year, it doesn't matter that they have $500 million in the bank today. That cash will just slowly bleed out over the next few years.
Just disappears.
Right. In that worst-case scenario, the stock doesn't just fail to break the 3.77 resistance. It gets violently rejected, falls back down, and continues testing that 2.36 floor. And if that floor breaks, there is no historical support below it to catch the fall.
Free fall. Okay, let's pull out of the nosedive for a second. I will take the other side of the trade because the bull case here isn't just wishful thinking. It has an actual foundation. BBAI is not sitting at the table empty-handed. First off, they have a massive confirmed backlog of over $400 billion.
Right, that's real.
That is contracted future revenue just waiting to be realized. Second, they have that $462 million in cash reserves, so they're not going bankrupt tomorrow. They have runway.
Definitely.
Third, they're actively expanding into Middle Eastern markets.
Yeah.
Why does that matter? Because they are diversifying away from being entirely dependent on the U.S. Army, tapping into regions that are heavily investing in AI and defense tech right now.
Those are strong foundational pillars, no doubt. But a backlog isn't cash in the bank until you actually execute on it.
Very true.
To move the stock price in the near term, you need catalysts. You need events that force the market to reevaluate the core business model. For BBAI, a major catalyst is the integration of Ask Sage.
Oh, right. That's the generative AI platform they acquired, right? How does that actually change the math for them?
It changes everything about their margins. Ask Sage already boasts over 100,000 users. Integrating Ask Sage, along with their CargoSeer acquisition, transitions them from providing legacy contracting services, which essentially just means putting bodies in seats and billing by the hour to offering highly scalable software solutions.
Because you build the software once, and you can sell it 100,000 times.
Exactly. That is how you fix a margin compression issue. Furthermore, their own 2026 guidance projects revenue rebounding to between $135 million and $165 million.
Okay, so if they hit the midpoint of that guidance, say $150 million, that would represent about 17% growth over 2025.
Okay.
That would completely reverse the narrative of a shrinking company.
It absolutely would. But, it relies entirely on management's ability to execute that pivot seamlessly.
Let me try to crystallize this for you. It sounds like they have a massive reservoir of water, that $400 million backlog. The water is absolutely there, but the plumbing connecting the reservoir to the house is just clogged right now.
That's a good way to look at it.
The U.S. Army volume dropped, the margins compressed, the pipes are basically leaking cash. The risk, the entire gamble of buying this stock is whether the management team can fix the pipes and get the water flowing as high-margin software revenue before the reservoir evaporates, or, honestly, the investors just lose patience.
That captures the dynamic perfectly. The bears and the technical trend are pricing in the fear that management simply won't be able to fix the plumbing. The bulls are betting that the management team, armed with almost $500 million in cash and these new Gen AI tools, has absolutely everything they need to clear the pipes.
So what does this all mean? When we bring this analysis home to your perspective as a listener, what is the timeline we're really looking at here?
In the short-term meaning over the next few weeks, you have to brace for extreme volatility. The next earnings report is slated for April 30, 2026.
Right around the corner.
Put a massive red circle around that date on your calendar. That earnings call will be the ultimate proving ground. The market is not going to accept vague promises anymore. They will demand to see hard proof that the 2026 revenue guidance of $135 to $165 million is actually realistic, not just a hopeful projection to keep the stock afloat.
And if they miss that guidance, or if the U.S. Army volume continues to drop, the market is going to punish them severely.
Undoubtedly. But if we connect to the bigger picture and zoom out to the long-term outlook, BBAI has a massive macro tailwind at its back. They are positioned squarely in a sector that is poised to benefit from roughly $320 billion in potential Department of Defense and Department of Homeland Security supplemental spending.
$320 billion.
Yep. And crucially, a lot of that spending is earmarked specifically for disruptive tech.
I mean, $320 billion. Even capturing a tiny fraction of a percent of that pie changes the entire fundamental thesis for a company of this size. But again, it all comes back to execution risk. It doesn't matter how astronomical the defense budget is or how massive their backlog is. If management can't actually convert those government contracts into real margin-positive revenue.
Precisely. The technicals suggest a market waiting to make up its mind caught between a heavy falling 200-day moving average and short-term bullish momentum that's trying to break 3.77.
Right.
The fundamentals are a violent battle between a pristine cash-rich balance sheet and a heavy cash-burning operational reality. So the lingering question is this. Will April 30th be the fundamental catalyst that finally breaks the long-term downtrend and validates the backlog, or will it prove to be just another bull trap in a relentless bear market?
That is the core debate right there. But before we go, chew on this. As Big Bear shifts toward generative AI with Ask Sage, they aren't just competing with legacy defense contractors anymore. They are stepping into the ring with Silicon Valley giants like Palantir, who already have massive government footholds. The real question isn't just if Big Bear can fix their own plumbing. It's whether they'll get crushed by the tech titans who already own the water supply.
That's a scary thought for the bulls.
Very scary. Remember, the market is a machine that transfers wealth from the impatient to the patient, but only if your underlying thesis is actually correct. You have to decide if the X-ray on this company shows a break in bone or a healing one. Thank you for joining us on this deep dive. Don't forget to like this video, subscribe to the channel, and most importantly, drop a comment below with your own verdict on BBAI. Is it undervalued or is it a trap? Let us know. Until next time, keep digging.